Hi everyone, I'm Paul and welcome to my review of Lesson 41 of ICT's 2022 Mentorship Program. This is the final lesson review in the series, and it's only fitting that we should be covering trade management and money management as we close out the 2022 Mentorship Program. But before we do, if you enjoyed today's video, please give it a like because that helps other people to find it. And if you haven't already, make sure you subscribe to my channel and turn on notifications so that you never miss an update. These are quick, easy, and free ways for you to support my channel. Lastly, if you'd like to hear more from me and join a community of like-minded traders, then make sure you check out the link in the description where you can subscribe to my free weekly newsletter and to join our Discord. Now that that's out of the way, let's jump into today's video. Today's video is a review of Lesson 41 of ICT's 2022 Mentorship Program. And so our outline for today's video, firstly we'll be talking about money management, which also includes trade management, and then we'll be applying some of those principles to a trade example on the S&P 500 or the ES on the 23rd of June. So we'll start off today's video with money management. And I've just put these points down. So these are, I guess, a culmination of some of the points that ICT's made throughout the YouTube mentorship program, but also just some of my own personal experiences, which I think will help you along the way in your journey as well. And so the first thing we're going to talk about is trading with live funds. And so you should really only be trading with live funds when you're truly ready. And there's no really fixed time limit or amount of profitability and demo trading that you should hit before you switch to live funds. So this is really, I guess, a personal decision, and it all comes down to the journey that you've been taking. But what I definitely suggest is that you don't go into trading with live funds until you've spent a significant amount of time back testing your particular trading system. So you just have a lot of reps doing that just in back testing, then you forward test that in a demo account for a significant period of time to the point where it's almost mechanical. Because when you switch to live funds, it will become more emotional, it will become more psychological, and you really want to be in that mindset of your trading system is almost mechanical, and you methodically go through those steps as you put your orders on and execute your trades in the market. So the more work you do, it's like just anything else in life, the more work you do before you go into trading live funds, the easier that transition will become. And the second point in money management is that capital preservation should be your highest priority. So obviously when most people go into trading, what they're trying to do is obviously make money, and that's what everyone is here to do. But the reality of it is when you go into trading, especially as you start trading with live funds for the first time, is that even if you had a high success rate in your demo trading and in your back testing, is you're probably not going to translate, perfectly into live trading with those same figures. And so the reality is you're going to make money sometimes, you're going to lose money sometimes. And so as you're going through that evolution from a demo trading environment to a live trading environment and just discovering some of the differences between doing it in a back testing and demo trading versus live trading, is that you're just trying to preserve your capital, because the longer you can do that, the more likely you'll be successful in the long term. So especially when you first start, your first focus should be on preserving your capital and just staying in the game for as long as you can, because you just want to build up those reps, build up your confidence, and then the profitability will eventually come. You just need to remember you can't play the game if you don't have any capital. So preserving capital in the first instance should be your highest priority. And the third point is on risk. And this goes back to the discussion we just had on capital preservation, is that you want to ensure that you can stay in the game for a long period of time. And so to do that, you need to be very disciplined about your risk. And you should have already been practicing this in your demo account, but obviously in live trading, it can become quite different because all of a sudden you're exposed to the emotions of making and losing money. So a good rule of thumb for new and emerging traders is to only ever risk 1% of your total capital in any given trade. And certainly for many people, even doing 0.5% would be even better. So yes, you may not make as much money in your winning trades, but equally you're not going to lose as much in your losing trades. And so again, this all comes back to preserving your capital, staying in the game longer, getting those reps up, building your confidence, and then as you start to develop, you can start to move your risk parameters around. And so our fourth point, and you'll see there's a bit of a theme here, is that losses and drawdowns are a reality of trading and they are going to happen to you. So as good as your system may be in backtesting and in your demo account, when we go into trading with live funds, is that may well change. And despite what you see on YouTube and Twitter and so on, is that traders make losses all the time, and this is just a normal part of the business, if you want to call it that. And this leads us to our final point in money management, is that you should only ever take 2 losing trades in one particular session. And so in that first trade, you may commit, your normal capital amount, which may be 1% of your account balance. And then if you have a losing trade and you go back in with another trade, it's a good practice to then halve the risk. So you'd be going in with 0.5% of your capital in that next trade. And the reason why we do this is if you're just not really in sync with the market and you have back-to-back losses, then you're minimizing the amount of drawdown that you're going to be taking, and then it's going to be easier to get out of that drawdown. Whereas if your first trade is 1%, your second trade is 1%, then you're already down 2% in terms of drawdown on your account, and that's much more difficult to claw back from. So you'll note all of these points sort of wrap around a very particular theme, which is about being conservative, taking your time, and really treating your capital the way it should be treated, which is it's precious and you need to defend that, and you need to be very disciplined in the way that you actually deploy your capital into the marketplace. And so if you follow these tips, it's going to help you to stay in the market longer, build up your confidence, build up your experience, and that is going to dramatically increase your chances of becoming a profitable trader in the longer term. And so in this next part of the video, we're going to use an example and go through some of those money management concepts that we just spoke about. So if we assume we've got an account size of $10,000 and we then want to allocate 1% of that capital per trade, we're obviously just going to take 1% of 10,000, which gives us $100. So that's the maximum amount of risk that we can attribute to any one particular trade that we take in the market. Now, obviously, going back to the points we just referred to before, if our first trade is unsuccessful, so we lose that 1%, we're going to go back into the market with a second trade, then we'd obviously go in with 0.5% because that's half of our 1%. So that would then be a maximum of $50 worth of risk that we'd go into the market with our second trade. And so it follows then that we need to determine what our position size is when we're going to go into the marketplace. And so there's a very simple calculation that we can follow. This is quite similar to what ICT did in his particular video, but what he did is he broke it down into the E-mini and then the micro in terms of the calculation. And I'm just sort of starting and going through the full calculations in this video just to be a little bit more clear for people who may not be familiar with that calculation. So in terms of calculating our position size, it's our maximum risk divided by the risk in ticks versus the tick value. So the number of ticks in terms of risk that we're going to take, and then the risk per tick. Now, in terms of if we're trading the S&P and we're going to be using futures, we have the option of trading the E-mini or the micro, and then the tick value is different between those two particular contracts. So in the E-mini, it's $12.50 per tick, and in the micro, it's $1.25 per tick. So often in videos, you'll hear people talk about points or handles. So that's one whole point on the ES or the S&P, and then within each point or each handle, you have 4 ticks. So another way of saying it is that for every point or every handle, it's $50 worth of risk. On the E-mini and on the micro, it's $5 worth of risk. So don't worry if that doesn't really completely make sense, because in today's trade example is we're going to go through all of the calculations around how to calculate your position size using a worked example from lesson 41. And so finally in money management, we're going to talk a little bit about trade management and very specifically about how to manage our stops. So in terms of our model, we should have a very defined place where we're going to place our stop in terms of when we go into the market. And that stop's very important is because that's what we're effectively spending to protect our capital. So that's obviously money well spent. You want to go into the market with defined risk. I'm never in a position where I'm just waiting for price to get to my mental stop and then I go into the market and execute. I always physically have a stop in the market. So in case anything weird happens, I've always got that protection in place, and that's what your stop is all about. So I think that's one really good point, is you always should have a physical stop in the marketplace. Never rely on a mental stop. And our first rule in stop management is that once the market or once price has reached 50% of our target, so where we anticipate or where we're planning on price to go, is we can then move our stop up by 25%. So we're just sort of giving us a small reward by reducing some of that risk as we've reached 50% or the 50% level in approaching our final target or our final destination. And then the final time we'll move our stop is when we've actually reached 75% of that target that we've planned for our particular trade. So price has gone up by 75% towards the target, so obviously quite close. And at that point, we can comfortably move our stop to break even or just a little bit better just to cover costs, knowing that we're very close to our target and hopefully that we'll hit it. But even if we don't, the worst case is we don't completely round trip that and have our 1% risk loss. We come back to that stop and it's enough to cover our costs, so we sort of walk away with no scratches. Now, we'll add to these rules that ICT gave in lesson 41 is often what I'll do, especially if I have a target which is, quite far away in terms of where the dealing range is or over the course of that daily range, and I've already mapped out where I want to take my partials along the way, is what I'll often do is once I've taken that first partial is I'll move my stop to break even or just above break even at that point. So even if the trade completely goes back in the other direction, is I've already paid myself. So this is another small variation on this particular theme, where if the trade is going in your way and you're planning on taking partials, that you've already paid yourself, and worst case scenario, you've already taken some money. So that's what ICT often talks about, is make sure you pay the trader so you've taken that money out of the market. So even if it goes back to where you started, you've already taken some money off the table. So we've jumped over to our charts now, and we're looking at the daily chart for the ES or the S&P 500. And so this is our trading example for today, and we're also going to incorporate some of those money management and trade management concepts that we talked about earlier in the video into the specific trade that ICT outlined in the PM session for New York on the 23rd of June. So we'll start by determining our bias, looking at the daily chart, just as we would as usual. So we've been talking a lot about this particular move where we took out the buy side liquidity. We've now taken out the sell side liquidity here. We've purged all of the sell side. And now obviously because we've taken out the sell side, we're now seeking buy side liquidity. So we've been talking about that since we painted this swing low just here. And so above this level, we have a bearish fair value gap, and we also have this opening gap just here. So this is going to act as that strong draw on liquidity. We obviously have buy side liquidity residing above these highs here as well. And you can see as the market's traded upwards, we've traded towards that. And so even though the trade example we're going to look at today is on the 23rd, which is in this candle here, if we just click the market forward, and you can see not only do we trade through the buy side liquidity here and we completely fill in that fair value gap, that bearish fair value gap, but we also fill in that opening gap as well. So if we zoom into our 1 hour chart now, you can see this is the price action from the 22nd and the 23rd here. So in this piece of price action here, you can see we paint a bullish fair value gap. We create this high here. As we go into the next part of the session, you can see we trade down in, we take out the sell side liquidity here, we trade into that bullish fair value gap, the market trades higher. Now it doesn't quite take out the buy side liquidity here before reversing. And again, we don't trade back in to that bearish fair value gap, but you can see the market trades upwards. Obviously this bearish fair value gap up here from the daily chart and the opening gap are acting as a strong draw on liquidity. Especially once we've taken out this buy side, you can see that we race up and we fill in both that bearish fair value gap and that opening gap from the daily chart. So we've zoomed in now to our 15-minute chart, and we're going to start framing out the trade that we'll be taking and then we'll be using in our money management and trade management example later on in the video. So we can see we have midnight New York time here as we come into the 23rd, and this is that bullish fair value gap that we outlined from the hourly chart. So you can see as we come into the London kill zone, we take out this sell side liquidity, we dip into that bullish fair value gap and we get a reaction from that. You can see we get this big displacement, we take out the buy side liquidity here, we drop back in to this bullish fair value gap from the 15-minute chart, and you can see again the market reacts to that. We trade higher as we come into that New York AM session. The market pulls back a little bit, and you can see as we come in to that New York open, we get a bit of volatility. Now ICT in his lesson 41 video, he actually talks about a trade that he took just here. So after we created this sell side, the market started to trade higher. He was anticipating that the market would take out this buy side liquidity and then continue up to take out this buy side liquidity here, obviously with that draw of the bearish fair value gap above acting as that draw on liquidity. Now that didn't happen, it obviously reversed here, and he goes through in detail in lesson 41 about how he managed that trade and how he was eventually stopped out and how you could have then potentially taken a trade in this other direction as the market reversed. I'm not going to go through that in this video because we really just want to focus on the money management and trade management, which is from the trade that we were taking in the PM session. So if we focus more on that particular setup, you can see the market trades down and quite strongly. We take out that sell side liquidity and we dip in to that bullish fair value gap that we painted here on the 15-minute chart in the London kill zone. We consolidate a little bit here and then the market races off and eventually hits that buy side liquidity, these relative equal highs that ICT was targeting earlier in the session. So we're on our 5-minute chart, and this is where we really want to focus because this is the execution that we're going to use in our money management and our trade management example later on in the video. And so you can see after the AM session, the market sells off. We come into that lunch session and you can see here at 1 o'clock, we get this stab downwards. So all of the stops are then cleaned out over that lunch period. We then get a reaction once all of that liquidity has been tapped out, and you can see the market trades higher. You can see as we trade higher, we get that displacement that we're looking for, and we have a bullish fair value gap that's formed on this 5-minute chart here. So remember, that's our 3-candle formation, 1, 2, and 3. And after that fair value gap is formed, you can see the market consolidates a little bit as we start to go into that New York PM session, and we tap into that bullish fair value gap a number of times. This particular candle drives right down into this bullish order block just here. You can see the market then reacts to that. It takes off. We get our market structure shift here, and then we're pretty much off to the races. You can see we have another bullish fair value gap which is formed here. The market again taps into that after consolidating for a few candles. We get another extension. Again, another bullish fair value gap is formed. We tap back into that a number of times before we then charge towards that buy side liquidity that's residing up here. So we'll now start to layer in some of our execution, money management, and trade management, which we talked about from earlier in the video, and we'll just sort of layer that on as we go through this particular trade on the 5-minute chart. So the first thing we want to talk about in terms of our trade setup and execution is our dealing range. And so in terms of marking out our dealing range, we're going to go from this swing high up here to this swing low here. And the reason why we use this swing high and this swing low is this swing high has broken or taken out this buy side liquidity, and this swing low has taken out this side liquidity. So we've sort of bracketed around the buy side and the sell side to create our dealing range. And remember, in our dealing range, we have our discount part of our market, and we have our premium, and we have our equilibrium, and as often the case on equilibrium, we have a fair value gap, which you can see here. So we obviously are looking for a long trade because we have a bullish bias, and so we want to be taking one of those setups inside the discount part of the array. So you can see if we have our dealing range from here to here, this is our discount, and this is where our setup is occurring. So we have our bullish fair value gap right here. We also have a bullish order block just here. So this is the down close candle before this up move, which also had an imbalance in it. And we use the open of that candle and we draw that across. So you can see we have a lot of confluence here already. We have this bullish fair value gap from the higher time frame. On our execution time frame, we have a bullish fair value gap just here. And we also have a bullish order block. Now, just to layer on a little bit of additional confluence, and this isn't something that's talked about a lot in the 2022 mentorship series, is this whole setup is actually an OTE, so an optimal trade entry as well. And so if we run our fib across our displacement range, so from this swing low to this swing high just here, you can see we get our 62% level here and our 79% level here. And by the market trading into that, that's ICT's optimal trade entry. And so in terms of our execution with this trade, we'd be going for a long trade, obviously. And just for ease, I've used a buy limit of 37.54.75 just so we can have round numbers, and then a stop of 37.45.75, so that's exactly 9 handles or 9 points, which is 36 ticks. And then our target in this example is going to be 37.79.75. And so you'll remember from early in the video we talked about position size, and so before we can obviously put our trade on, we need to know what our position size will be. So how many contracts are we going to be able to trade? So we're going to stick with our $10,000 account. And remember, if we're going to use a $10,000 account and we're going to use 1% in terms of our risk management, then that's $100 of risk. And so if we want to calculate our position size, obviously, we need to figure out if we're going to be trading the E-mini or a micro, and that's all going to come down to the amount of capital we have. And so remember, to calculate our position size is we take our maximum risk divided by our risk in ticks by our tick value. So if we're going to calculate our position size, if we're wanting to trade the E-mini, we just simply plug all those numbers into our position size calculation. So our position size would equal 100 divided by 4 times 9, so that's 4 ticks per handle, and we're looking at 9 handles or 9 points, times the tick value, which for the E-mini is $12.50, so that gives us 100 divided by 36 times $12.50, or 100 divided by 450, which is basically 0.2. So we don't actually have enough capital in this example to trade the E-mini, so we'd have to look then obviously at a micro. So again, we just plug in the same calculation again. So our position size, so our maximum risk is 100 divided by 4 times 9 times $1.25. So we're obviously using the micro, which has a different tick value to the E-mini. And that equals 100 divided by 36 times 125, which gives us 100 divided by 45, which gives us about 2.2. So we can then trade 2 micros with our account size. So remember, you always want to round down to the nearest contract, because if you round up, that could take you past your maximum risk. And so finally, now how would we be managing our stop throughout this trade? So obviously if we entered the trade here, we'd be looking at that 50% level. We'd be looking at the 50% level as the first time that we could potentially move our stop. So what I've done is I've got my fib over on this side here, so from 0 to 1, and our target is up here, obviously at the 1 level or the 100% level. And you can see our 50% level would be just here. So as price traded up to this 50% level here, so you can see just as we would have gotten this acceleration here, at that point, we could have moved our stop up by 25%. So this is obviously, you can interpolate this a little bit. So we'd be potentially, say, moving our stop to about there at that point. And then once we reach the 75% level, that's when we'd have the ability to move our stop once more. So we'd get to around this level as we created this fair value gap here. We could then move our stop right to break even, or potentially just slightly above break even, just to cover our costs if we get round tripped or if price comes back to this level that we entered our trade at. Thank you for watching this final review, which is lesson 41 of ICT's 2022 mentorship program. I hope you enjoyed this video on money management and trade management. Preserving capital is one of the most important things for new and emerging traders. So I hope you found some of the concepts and some of the insights in this video helpful, and that you're able to incorporate them into your trading plan. If you did, it would be great if you could like it, because that helps other people to find it. And if you enjoyed this content and you'd like to see more of it, then make sure you subscribe to my channel and turn on notifications so that you never miss an update. And finally, remember, if you'd like to hear more from me and join a community of like-minded traders, then make sure you check out the link in the description where you can sign up for my free weekly newsletter and to join our Discord. Thanks for watching, and I hope to see you next time.